Hello all. So today's topic for discussion is about financial statement analysis. So we are moving towards your third unit in which we are going to discuss what are financial statements, what are the various tools that are used for analyzing the financial statement, and what exactly are this analysis means. Okay, so with that we are moving on to the first slide. The first thing what you are going to discuss is what are financial statements. So before going into the analysis purpose, you should understand what do you mean by financial statement first of all. So financial statements are written records that convey the business activities and the financial performance of a company. Financial statements are often audited by government agencies, accountants, firms, etc. to ensure accuracy and for tax, financing and investing purposes. So whatever written records you're maintaining in your organization, and if that written record can show the financial position or performance of your company, it means they are financial statements. Okay, so now let's take an example of an ordinary man who is not running a business and all, but he has an habit of noting down his expenses and incomes that are happening in his life. So for example, this person is taking note of all the expenses that is incurring for him over a month. So that single notebook can also be considered as a financial statement, which means he is recording all the incomes and all the expenses of his day-to-day transactions and day-to-day life in that single notebook. By using that notebook, that person will be able to understand that this person has got this many or this much of amount during this period and he had spent this money or this much of amount during this period. So it is a statement showing the day-to-day activities and the cash inflow and outflow of that single ordinary person. Okay. So now when you compare that person with a person who is doing a business, this business people will have separate documents which will record all the transactions happening in their business. So maybe that transaction which is recorded will be recorded in a predefined manner, or that recording purpose will have a format. Okay, so in case of an ordinary man, it's just a notebook. But in case of a businessman, he'll have separate accounts, separate format to note down those expenses and incomes and transactions and all those things. So when you take that particular written record, that is known as financial statement. Okay. So for example, if a small scale businessman is just taking note of the incomes and expenses, you can prepare it in a predefined format and in a income statement or income and expenditure statement format. So there are so many formats available for recording your transaction. So basically what I mean is any written record or any written document which will be able to convey the business activities and the financial performance or the financial position of your company. That record or that written document is known as a financial statement. Is that clear? So why is this financial statement very important? Because it is very important to let others know about your standing position of the company, or maybe it will be used for any auditing purpose, it will be used for tax purpose, it will be used for financing and investing purposes, and so many things can be done using this financial statement. Imagine if you don't have a record of the transactions happening in your company, you will not be able to identify whether you are incurring profit or loss. Yes, so that is why financial statement is very important. So what are these financial statements, or what type of financial statements are very important, or what are the things that are included in financial statement? Let us see one by one. First thing is balance sheet. Okay, balance sheet is something or a financial statement which shows the financial position of your company or the strength of your company or how your company is performing. How How can you say that? By seeing a balance sheet, you can understand the financial position of the company. Yes, if an outsider is watching your balance sheet or analyzing your balance sheet, if we find that the liabilities or the liability column is more exceeding than your asset column, it means you are owing so much of amount to the outsiders or the creditors. It means the financial position is not that good. Yes, so that is why balance sheet is one of the most important financial statement which is used for analysis. Second one is income statement. So income statement or income or expenditure statement states all the transactions or the revenues and expenses that are incurring in your company. Thirdly, it is cash flow statement, one of the most important statement which will show the inflow and outflow of the cash transaction in your company. Okay, and lastly, statement of changes in equity. So changes in equity. Equity is the thing that is available after you pay off all the liabilities. Yes, we'll see that in detail. So if there is any changes in the statement of this equity, that will also affect your company's performance. So all these four are the basic financial statements that are used for analysis in our common scenario. Okay, so what is a balance sheet? We'll see each one of them in a detailed manner. What is a balance sheet? Yes, balance sheet is a statement of asset, liability and equity of a business or other organization at a particular point of time. So if you take for over a one period, the point of time or period is 1 year, it will be a short-term period, and the statement of all the assets, all the liabilities, all the equities, that statement showing such thing is known as a balance sheet. So it's very important for a company to prepare a balance sheet in order to know the position of that company. Yes, so what basically this balance sheet is into, so that is why we are breaking this balance sheet into three main sections. The first thing is asset. So asset are those resources or things which the company owns. So whatever you have in your hand, that will be known as asset. Okay, they can be divided into current asset, non-current asset, long-term or short-term asset. Based on the period and usage of that asset, it can be divided into current and non-current assets. Second one is liabilities. Liabilities are the debts or the obligations of the company. So whatever debts you have to pay to the creditors, or whatever the amount you have to pay to the creditors or you're owing to the outsiders, those amount will be known as liabilities. Maybe you're renting or you're taking loan from a company to rent a building. That will also come under as a liability. Yes, but if you're purchasing a building of your own, that will come under a asset. This is all very basic things. And third thing is equity. Equity is that shareholders' equity, or simply equity means the amount of money that would be left over if the company is paid off all the liabilities. When the company is going for a liquidation, or maybe it's time for it to wind up. So when all the liabilities are paid off, and still if you have money, that is shareholders' equity. So these three are the main three or the basic three sections that should come under a balance sheet. Yes. Next thing is income statement. So we are just going through what are these, what is what. And basically if you move on to the problematic usage of this balance sheet and income statement and all, it's much more wider. Okay. So we are just going in an examination point of view to read what the theory are coming under all these things. Okay, so income statement is one of the three important financial statement which is used for reporting a company's financial performance. That is over a specific accounting period. Okay, so like other two statement, income statement is also one of the most important financial statement which will show the position of your company. Okay, and also known as profit and loss statement or statement of revenue and expenses. The income statement primarily focuses on a company's revenues and expenses during a particular period. So income statement is one which focuses only on the company's revenue and expenses over a particular period. So for example, it may be a 1 year or one accounting period. Okay, so it will record all the revenues and expenses that are happening in your company. Okay, next, third one is cash flow statement, which I told you it's very important because it records all the inflows and outflows of your company, and it will show the cash position of your company. Okay, so that is why this is also an integral part of financial statement. Cash flow is a very wider topic, and which we will discuss in very detailed manner in your coming units. Okay, so we are just going through what are these things. Okay, so how will we analyze this financial statement? So how are we going to analyze this financial statement? So, or what does this financial analysis means? Okay, so financial analysis means a process of identifying the financial strength and weakness of the firm by properly establishing the relationships between the item of balance sheet and profit and loss account. So when you compare so many financial statements together for a period of time, when you find that the company is strong or weak, that process is known as a financial statement analysis. Okay, so in order to do that, you compare so many financial statements like balance sheet, income statement, cash flow statement, and changes in equity, everything. Okay, so this assesses the financial health and performance of the company. Okay, this is what we are talking about from the very beginning. Yes, then it consists of comparison of one company over a period of time, or maybe too many companies over one industry. You can compare one company from 1 year to next year, or you can compare one company to the next or competitive company. So many things are happening when you do financial statement analysis, and for doing so many things, there are so many other tools also. Okay, so what is the need for financial analysis? You can ask me, is it not enough to see the balance sheet and understand the financial position of the company? Yes, it's enough. But in order to understand it more better, it is always necessary to have financial analysis. Okay, so that is why the first thing is you should understand the financial performance of a company over a period of time. From 1 year to the next year, what was the performance happening? Next thing is you should understand the financial position. So in which position are you when you compare your company to your competitors? In which financial position are you in? And what is the prediction of future performance? So based on the performance and position of your company's finance, what are the plans for the future? Everything can be understood. And also you can also know the operational efficiency of the firm. Is it good enough to operate, or is it healthy enough to operate? Is the finance really healthy? Everything can be understood. Yes. Next thing is you should understand the tools for analysis. You should understand what tools are there for analysis in basic financial statement analysis. So first thing is you have comparative statement. Nextly, you can use common size statement. Next is there is trend analysis, and also there is ratio analysis. So we'll see each one of them in a separate slide. Comparative statement. So the figures of financial statement are converted into percentages. So what basically happens in a comparative statement is that you'll have so many financial statement in your hand, isn't it? So when you convert one or these financial statement into percentages, it will be coming under comparative statement. The balance sheet items are expressed as the ratio of each asset to total asset and the ratio of each liability to total liability. And the items are expressed as percentages of base year. It is time series analysis. So it can be understood very clearly with the picture. Now you see the items that are seen in these things. See, this is an income statement. So items that are seen here, net sales is here. You can see cost of goods sold. You have profit. Everything is available. So basically what you're going to do is you are converting all the items into percentages. So what you're doing is you're converting all the items given in the transaction into percentages by taking sales as your base, or maybe you take profit as, this is a income statement. So in this they have taken profit as your base. Okay, so that is why they are telling that each expressed as percentage of base year, and balance sheet, if it's a balance sheet, you will have a total amount in the asset column, right? So that total amount will be taken as 100%, and all other items, like for example current asset is this many, non-current asset is this many, everything will be taken according to the percentage by keeping the total asset column as the base thing. So here you can see usually you are taking the profit as the base, and based on this you're calculating all other items in percentage. You'll understand it when you're doing the sum. It's just the format of how you are going to prepare a comparative statement. So format is that you will have a base year, that is you will have a current year and a previous year. So based on the previous year, you're going to convert all the items into percentages. So when you compare 2 years, you will see the change, or if you can see, net sales is 2 lakhs in 2016 and 2,50,000. What is the change? It is an 50,000 there is a difference between 2 years. So based on this, you will convert this 50,000 into 25%. Okay. So how that is everything you can understand in clear manner when you're doing a problem. So this is a basic format of comparative statement. Next is common size statement. Common size is a horizontal analysis, and it shows the financial position of company at different time periods. So on each time period, you can understand what is the position of the company. So this is somewhere similar to a comparative statement, but this is also based on the percentages what you're happening, and the total asset and total liability will be your base thing. You can see this is 100% and this is 100%. So based on the total asset and based on the total liability, you will calculate all other items and you will earn a percentage. Now for 1 year you will see 1%, for next year you will see 1%, and you will compare it. You can also understand it when you're doing a problem. So this is a format of common size balance sheet. And ratio analysis. The ratio analysis is the most popular way of analyzing the financial statement. And based on there are so many ratios, so many variants available, and it's very important and widely used tool for analysis of financial statement. So this some type of financial or ratio analysis. You are having liquidity ratios that measures the firm's ability to meet current obligations. Okay, leverage ratios, it shows the proportion of debt and equity and financing the firm's assets. You also see activity ratios. They reflect the firm's efficiency in utilizing the asset. And there is profitability ratio. It also measures the performance and effectiveness of a firm. So these are some types of ratio. I'm not going so deep into it because it's just an introduction video of what is what. Okay, and from the next class we'll be discussing what is comparative statement, what is its actual format, and how you're going to deal with the transactions when you take it into a comparative statement, and so on. Okay, so hope that this is an introduction video, and that's why I'm just giving you the gist of what is what, and from the next class we'll discuss it in very detailed manner. Okay, so thank you for listening.